Warren Buffett just made the most confusing move of his career. Back in May, he told everyone to stay away from real estate. 3 months later, he quietly dropped $1 billion on home builders. So what changed his mind? And what does this mean for your money right now? I'll tell you exactly what it means and how this could be a real gotcha moment, because here's what Buffett knows about real estate. And I'll use this property in Middle America, Nebraska to demonstrate. Zillow has it valued at $219,900. And we want to know, how much money would this property make us? Well, this is how you figure it out. The ROI matrix. And this represents the 4 profit centers of real estate. The first profit center, appreciation. The annual appreciation on record since 1891 is 3.4%. So at the end of 1 year, that would give us an appreciation of $7,477. Now, to figure out what our ROI is on that, if we paid cash for it, it'd be very simple. It would just be that, $7,477, 3.4%. But most people will put 20% down to purchase a property. I mean, that's how most people buy houses. So our return is not calculated on the price of the property, but on how much we put down. 20%, that's $43,980. Now we take our appreciation profit of $7,477 and divide it by our down payment, the $43,980, and that gives us an ROI of 17%. So in our appreciation quadrant, we're sitting at 17% return. Now let's look at the cash flow. On this same property, the rent estimate here is $2,292. We take 40% of that to cover taxes, insurance, maintenance, vacancy, and management. That's just the quick and dirty math, so we're left here with 60% of our rent. That's what we get to keep. And that gives us $1,375 a month in net operating income. So from there, now we got to subtract our mortgage payment. So say 6.5% interest right now, fully amortized over 30 years, the payment comes out to $1,112 per month. That leaves us with $263 per month in positive cash flow. So we multiply that by 12, and we've got $3,159 a year in cash flow after debt service. Now, divide that by our $43,980 down payment, and that's a 7.2% cash-on-cash return. Now, let's look at the depreciation. The IRS only lets you depreciate the building, not the dirt it sits on. So we take 80% of the purchase price. That represents the structure, the building. That leaves us with $175,920. We divide that by 27.5 years, and we get $6,396 a year in depreciation. So the IRS lets you pretend your property lost $6,396 in value this year, even though it probably didn't. And at a 33% tax bracket, that saves you about $2,111 in taxes. That's going to vary for everybody depending on your tax bracket, but that's how you'd calculate that. That's money you keep, which is just as good as money earned. That's 4.8% return just from your depreciation. Now let's go to amortization. So each month you make that $1,112 mortgage payment. In year 1, only a small slice of that goes to the actual principal, but it still adds up. I mean, in year 1, about $1,966 goes to your principal paydown. That's not you writing a check really either. That's your tenant paying down your loan for you, albeit it's indirect, it's still them paying it. So divide that by our $43,980 down payment, and that's a 4.5% return on your investment just from the amortization. Now let's add it all together. Appreciation ROI is 17%, the cash flow is 7.2%, the depreciation is 4.8%, the amortization is 4.5%. That's a 33.5% total return in year 1. Did your 401k return that last year? And remember, that number only grows over time. Cash flow, that's going to rise with inflation. And amortization, that's going to accelerate every year as more of your payment goes toward the principal. That's not stock market stuff. That's real estate math. That's the ROI matrix that Warren Buffett understands. Then why did he stand up at Berkshire's annual meeting in May and basically say real estate is a nightmare? His exact words, real estate is so much harder than stocks. You've got negotiations, time, lawyers, multiple parties. He said there's way more opportunity in the stock market. I mean, you can buy billions in stocks in 5 minutes. Real estate deals take forever. This was a complete flip from 2012 when he said he'd buy hundreds of thousands of homes if he could. Imagine if he did. But here's where it gets interesting. August rolls around and Berkshire's secret filing drops. $800 million in Lennar Corporation. $191 million in D.R. Horton. Nearly $1 billion total in companies that build houses. The same guy who said avoid real estate just went all in on real estate companies. So what's going on here? Well, first, let's understand why he said stay away in May. You see, mortgage rates hit 7%. Home prices are sky high. You need to make $126,000 a year just to afford the average house. Buffett looked at this market and said, no thank you. But then something clicked. He realized there's a huge difference between buying houses and buying the companies that build them. When you buy a house, you're stuck with one property in one location with one tenant. When you buy home builder stocks, you own a piece of a machine that builds hundreds of houses across multiple markets. But wait, isn't inventory rising like crazy right now? I mean, if we can't sell the homes we got, why invest in companies to build more? Because despite the affordability crisis, America still has a housing shortage of 4 to 7 million homes. And here's what most people don't get about this shortage. It's not temporary. This is a structural crisis that's been building for 20 years. Zillow says we're 4.7 million homes short as of 2023. Even after a 5-year construction boom that added 1.4 million homes, we still fell behind because 1.8 million new households formed during that same period. At current construction rates, it would take builders 7.5 years just to close the gap. But that's assuming that no new households form during those 7 years, which is impossible. This shortage has created a mess that most people just don't see. 8.1 million families now double up by sharing homes with strangers. Millennials make up 38% of these arrangements. Gen Z accounts for 29%. An entire generation is living like college roommates because they can't find their own place. Even with record construction in 2024, we completed 1.63 million units. That's the highest since 2007. Still, not enough. This is why Buffett made his move. He sees what's coming. And here's what triggered his timing. Jerome Powell's Jackson Hole speech on August 22nd. Powell basically announced the Fed is about to start cutting interest rates. His exact words, the baseline outlook and shifting balance of risks may warrant adjusting our policy stance. Translation, we're cutting rates, and we're doing it soon. The market immediately priced in a 90% chance of a rate cut in September. When the Fed cuts rates while the S&P 500 is trading at an all-time high, something really magical happens. There's a historical pattern that's played out 20 times since we started tracking this stuff. When the S&P 500 trades within 2% of all-time highs and the Federal Reserve cuts interest rates, the market posts positive returns 100% of the time over the next 12 months. Not 90%, not 95%, 100% of the time. The average return is 13.9%. But here's what this means for real estate. When the Fed cuts rates while stocks hit record highs, it creates what economists call asset price inflation. Lower interest rates make all income-producing assets more valuable through basic math. Real estate gets a double boost. Borrowing costs go down while asset values go up. This is exactly what Buffett recognized when he made his home builder bet. And here's the thing about his timing. Home builder sentiment hit 32 in August. Anything below 50 means builders are pessimistic. 37% of builders were cutting prices. 66% were offering incentives because they couldn't sell these places. I mean, everyone was panicking about a housing crash. Perfect time for Buffett to strike. I mean, this is classic Buffett strategy. Be greedy when others are fearful. You see, while everyone else is running for the exits, he's backing up the truck. But his investment structure reveals something smart. Rather than buying actual real estate, he chose liquid home builder stocks. These companies benefit from the housing shortage while maintaining flexibility to adjust as conditions change, and they might. Plus, home builders have pivoted towards build-to-rent models. The sector has grown 270% since 2019. They now control over 350,000 rental homes. This positions them to profit from both home ownership demand and rental market dynamics. The convergence of these factors creates a perfect setup for real estate appreciation. Supply constraints from the 4.7 million home shortage represent decades of underbuilding. Demand support from millennials forming households and continuing population growth. Fed rate cuts reducing borrowing costs. And institutional recognition as Buffett's investment validates the thesis. But let's play devil's advocate for a moment. What if Buffett is wrong? What if those home builder stocks crater? I mean, here's what could go wrong. Construction costs could keep rising, interest rates stay high longer than expected, a recession kills housing demand. But here's the thing, even if Buffett's timing is off, the structural shortage remains. Worst case, he's early, not wrong. And that's exactly when you want to follow smart money. Market technician Walter Deemer put it perfectly. When it's time to buy, you won't want to. Think about that. Right now, every headline screams housing market crash. Your gut says stay away. Your friends say wait for prices to drop. You call that guy on YouTube that's advocating for you to buy a house, you call him an idiot in the comments. It's okay, my feelings aren't hurt. The point is, that's exactly when the smart money moves in. I mean, it's a little frustrating, isn't it? I know. That's why I put together some helpful information for you. You can get a copy of this at frustratedinvestor.com. I uploaded it over there for you to make it easy. Buffett didn't buy these stocks because he loves home builders. He bought them because everyone else hates them right now. The same psychology applies to your real estate investing. When mortgage rates are high and everyone's scared, that's when the best deals surface. We've been seeing that a lot over the last 12 months. When sellers are desperate and competition disappears, that's when you find the opportunities. But here's the problem most people face. They know they should buy when others are fearful, but they don't know how to actually do it. They think they need to quit their job or risk everything or become a full-time real estate investor. No, that's nonsense. Your W-2 income is actually your biggest advantage in real estate investing. Banks love steady paychecks. You have access to financing that full-time investors envy. You can start building your portfolio without risking your career or your family's security. And that's exactly what I show you how to do in this video right here.